Saving money can be difficult these days, with so many other things to do and cost of living pressures. It's very easy to get caught up in spending everything you earn, which makes budgeting so important. We're making saving simple, and no matter where you are in life, we have a variety of transaction savings and investment accounts to suit your banking needs. We even have a kids saving account to help them learn the importance of saving and budgeting. Talk to us today.
While rates move up and down, you should always consider the impact they will have on your mortgage. The rate of interest you'll pay on your mortgage depends on a combination of factors. This can include the Reserve Bank of Australia's cash rate, your lender, and the type of loan you have. When working through your loan options with your mortgage broker, there are a number of issues to keep in mind to ensure you're getting the most appropriate mortgage for your needs. Different loan types tend to come with different interest rates. So if your loan has a range of features, such as redraw, offsets, or early repayment facilities, you'll usually pay a little more in interest. Alternatively, while a basic loan doesn't have all the bells and whistles of other products, the interest rate is typically lower. Rates move up and down in line with the economic cycle. If there is a trend that rates are moving upwards, some borrowers are choosing to fix their home loan rate or lock in a rate for a set period of time. If you're considering this option, it's important to remember that a fixed interest rate is usually higher than the current variable rate. However, if rates are on the rise and you're concerned they'll keep going up, fixing your rate will ensure consistency in repayments each month. Alternatively, a split loan can give you the best of both a fixed rate and variable rate loan. This means that if rates rise, a proportion of your loan will be protected, minimising the impact of higher monthly repayments. If, on the other hand, rates fall, your fixed rate will remain higher and the variable part of the loan will fall. You also keep in mind that when taking out a loan, you should always leave room for a number of possible interest rate rises. If you're unsure of what you should do, please contact us so we can help assess the best option for your situation.
What is a managed fund? A managed fund is simply a pooled investment vehicle, which means that a number of investors have contributed money to the fund. An investment manager then invests the funds on behalf of the unit holders. The main advantages of using a managed fund to invest are: the money in the fund is managed by a team of investment professionals. You can get exposure to investments that you, as an individual investor, may not otherwise be able to access. For example, international shares or shopping centres. Managed funds are typically diversified. Some funds may hold shares in 30 companies, while others more than 100. Some may invest in property, while others fixed interest assets and cash. As a unit holder in the fund, you're entitled to receive income distributions based on the number of units you hold, and these can normally be reinvested back into the fund or paid out to you. At tax time, the fund manager will prepare a statement for you that gives you and your accountant all the information they need to complete your tax return. On the flip side, the disadvantages to using a managed fund are: you have no say on how your money is invested. The fund manager makes all the decisions. It's impossible for a fund manager to be able to take all unit holders' individual circumstances into consideration when making investment decisions. So from time to time there may be tax to pay on distributed capital gains or income. Unlike accessing a bank account or selling shares, it typically takes 10 business days, this can be longer, for withdrawal requests to be processed. Fund managers charge fees to manage the investment portfolio and to cover their administrative costs. There are a large number of managed funds to choose from, which is why it's important to seek advice on which managed fund is right for you. Reading the product disclosure statement your advisor will give you is also important so you can understand how the fund operates. If you require more information, please contact us.
Take the risk management test. Everyone faces some level of financial risk, but most people hope that catastrophe will strike someone else. Sadly, someone else may be you. This is why it is critical to review your insurances regularly and ensure they still meet your needs. Would you be able to cope with the risk of inadequate cover? Have you got too much cover? If circumstances have changed, have you adjusted your insurance? You can be systematic in looking at the risks you face. Firstly, identify the risk. Secondly, analyse how significant the risk is. And lastly, decide how you will handle the risk. Your choices are reduce the risk in some way, like installing burglar alarms, build up significant financial reserves so you can manage a loss if it occurs, saving, or buy protection in the form of insurance. Everyone is different, and for that reason, we recommend a periodic review with a risk management professional such as your financial advisor. To start with, what would happen if you lost your house, lost your car, lost your investment property, lost your personal effects, lost your income, were hospitalised, were unable to work through disability, died? It's easy to tick a box quickly without too much thought. Make sure you consider issues such as the rising costs of rebuilding your home and replacing lost assets, debt secured against assets such as mortgages and investment loans, providing for people who are dependent upon you. If the number of your dependents has reduced, you may have more insurance cover than you need. A change in marital status, accumulated leave from your job, such as sick leave, long service leave and annual leave, your health and those of your dependents. But it's not easy to work through this alone. Use this grid as a starting point and make an appointment to see us. We can ask the questions you haven't thought of. Even if the analysis shows you have managed your risks effectively, it will be worth the time for peace of mind. And don't forget, next year you need to do it all over again, because the only constant in our lives is change.
Saving money can be difficult these days, with so many other things to do and cost of living pressures. It's very easy to get caught up in spending everything you earn, which makes budgeting so important. We're making saving simple, and no matter where you are in life, we have a variety of transaction savings and investment accounts to suit your banking needs. We even have a kids saving account to help them learn the importance of saving and budgeting. Talk to us today.